Joining us today, Samir Arora of Helios Capital, and someone who is always got bold opinions on what's happening in the market. Samir, what a great time to speak with you, given all the action that's taking place on the world stage. Everyone's really wondering how this is going to impact us. What's your take on the recent power play that we saw at the SCORE summit between Modi, Xi and Putin?
Well, I guess, good morning. But basically, the idea is that India has to also show that, it is not being subject, it's not like a hostage situation that you can't look at other alternatives. And so it is not to, I guess that India should not be projecting itself as if it is forming another group, but that this is just normal, this thing that you have good relations with all potential and actual partners, and also give more choice to Indian business, Indian government to have their own policies and their own framework. It is not so much of a market moving impact, but all these things are required for future negotiations that may be down the road.
That's just it, Samir. I wanted to discuss that further with you, because if we just take a look at some of the stats, India's trade deficit with China was a record $99 billion for the fiscal year 24-25. Exports at about 14, imports at about 113 billion. And imports from Russia stood at about 63.8 billion, driven, of course, largely by crude and fertilizers. Right, while exports were modest. So given this kind of display that we're seeing, how much potential is there really for some of these dynamics to change on the global scale? How much dependency will continue on the US? You know, last you'd also mentioned that you didn't see India as having too much negotiating power. But given the kind of new partnerships that are seeming to be indicated here, do you see a shift over the next few months?
So, before that, if we look at what is India's surplus or whatever with US, that also is not really a direct surplus in the sense, suppose we export 20 billion of mobile phones via Apple or whoever, maybe, I don't know, 15, 16 billion of that is also coming in via China and getting processed, maybe similarly in gems and jewelry, sure. Similarly in energy, that there is a big import content. So it doesn't mean that we have a 40 billion surplus with US, the actual, it's just that it's in different accounts. The surplus is in one account, the deficit may be in another account. But I think particularly with China, the issue is, according to me, not so much of that whether Indian exporters can sell to China, which I think looks difficult. I don't know, maybe in a few items here or there, but mostly that we are offering our market in return for investments and easier day-to-day business in terms of, getting in rare earth or getting in these tunnel boring machines or whatever. But more than that, China is desperately looking for new markets and we are desperately looking for new investments. And putting aside what is our current trade deficit, we should look at new investments with, in a sense, negotiating on that. For example, if BYD has to come in, what should BYD deliver to India in terms of investments, in terms of localization, in terms of some export commitment, whatever. But don't connect it with the past, because otherwise we'll say, oh my God, there's 100 billion deficit now. Is it going to increase? These are all in aggregate you get from somewhere, you send somewhere. And for example, Apple is sending us, China might be sending us, I assume, $14-15 billion worth of things for Apple, which we wrap around, do something and send it off to US for a 18-20 billion type of export number. But in aggregate, when you combine these, the value add will be 2-3 billion. So it's not that you are replacing US, but you have to move along, get new investments. And also in some areas, anyway, it was not to come from US. Like if you wanted solar investment in solar or investments in EV or batteries, it was anyway supposed to come in theory from some of these countries. But because of the tensions with US, that has allowed India or forced India to look for partners who we were previously maybe not looking at because of whatever was the dynamics at that point of time.
So do you feel, Samir, because the markets were still watching out to see whether Trump would somewhat backtrack, at least from the additional tariffs, do you think that there's still room for that to happen, or do you feel perhaps we should just now, as you said, move on, regardless of, even if he pulls back in the short term, because you don't know what he's going to do again the following week?
No, first thing is that the market can move on, but the country and Prime Minister and
Yeah.
all cannot move on, in the sense that obviously we need to continue the diplomatic and other initiatives with US. It is not an either or kind of a situation. But from a stock market point of view, because things get discounted very fast, maybe we can move on. But in the end, you would like that 25% to be removed. And in return, maybe we have to do some things. Maybe there'll be, new people negotiating and blaming the old people or something like that, just to sort of move on, or maybe do a few things here or there. But you can't say it's okay to be the highest tariff country in the world and it doesn't matter. It matters to the economy, it matters to jobs, it
Sure.
matters to wages. It may not matter literally to the stock market because of these sectors being not so much in the stock market, and in aggregate not very big, and they may find new markets, but all those things will take months and years. You can't immediately replace one market with another. And there are jobs involved in shrimp farming and carpet making and gems and jewelry, which stock market may not care, but the system has to care.
Absolutely. And that's why, I really want to get a sense from you on the sentiment hit, even if it seems to have stabilized for the moment. Given that we don't know what's going to happen next, we've already seen a massive outflow, and foreign funds also seem to be moving back to China. They seem to be preferring that option at the moment. Last I, spoke to you, I know you said it was slightly a structural pullback, but do you think there's more to it? And secondly, do you also feel that China's making somewhat of a comeback? Because while we've seen FIIs pull out, I think about 35,000 crores from Indian equities in August. If we look at perhaps some of the global indices, we're actually seeing, whether it's the Hang Seng, whether it's the Shanghai Composite, seeing strong double-digit returns, 28% on the Hang Seng, 18% on the Shanghai Composite. Kospi is up 32%. So what's really happening in Asia?
So first of all, prior to this July, August thing, where obviously whatever we may say that it has limited impact, but it did have an impact, the
Yeah.
fact that we were singled out. But prior to that, from Feb end to now, the flows into India were positive. And in July, August, this should not be viewed as a big call on India, but a natural reaction to the fact that the results were sort of okay, or so.
Yeah.
And then you had this big negative, but there is a structural thing, which is that the world is reducing its allocation to US. Now, the currently in the world, the US is about 65%, 67% of the world index, and you can see it in flows into non-US ETFs and to emerging markets. That flows are increasing. Maybe it reduces 2-3% in US,
Sure.
3-4%, 2-3% kind of thing. But that on a 30-35% base means 7-8-10% increase. Now, in that, normally India would also have a case to get some flows. But because this negative came out, so there will be some selling, whether we like it or not. But I don't think that beyond a point, that trend of investors, US and non US, reducing a little bit of their exposure to US, which results in a meaningful difference for the rest of the world going away. So I still think that in the end, FIIs will invest into India. Also, one more thing is that when we see today the flows that are negative, please note that on the negative side are a lot of PE investors who, some of them who come in as FDI and get classified as FDI, and some of them come in as FII or FPI. And that money leaving or selling is not a view on India relative to China or India relative to emerging markets, but in itself a view that those guys put money in 10 companies, two of them have gone public, eight of them, three of them will maybe go public later, and five of them they will lose money or go to zero. So when
Right.
these companies go public, naturally the guys who've been around for 4 or 5 years in those companies will sell. So what I mean is FII outflow is not 100% a view on India versus some other market. The
Okay.
regular FII who was investing in emerging markets in Asia, he is not, according to me, that negative. And actually, they were positive till July beginning. And then
Okay.
this event and the fact that the results were not so great has led to it. These things will correct with time, and this any more surprise hopefully will be positive to no surprise or no change. So therefore, I still feel quite okay with the fact if the world goes up and if China goes up. So there's one more quickly. Previously, we used to say that Indian market is trading at a big premium to emerging markets, and that was one story that Indian premium is too high. Now, in last 1 year, China is up maybe 40% or something, and all these other markets are up, and India is flat to down. So even that argument has gone away. We just have to have a little bit of a turn in the sentiment and a little bit of these interest rate cuts and liquidity injection and GST cuts, something leading to and maybe festive season or good monsoons or something,
Something.
plus minus a few months, I think we will be in position to ask for our fair share from FIIs.
Okay, interesting. I'm going to come back to some of the threads there, but talking about GST, let's look at that because markets are now keenly awaiting, what really is going to happen here. They're meeting on the 4th and 5th of September for rationalization of slabs. Just to recap some of what's expected, possibly removal of 2 slabs from, moving to 2 slabs from 4 and elimination of the 12% and 28% tax slabs. And approximately 99% of items taxed at 12% could move to 5%. These are some of the things expected. 90% of goods taxed at 28% could now move to 18%. And of course, areas like FMCG, consumer will set to benefit the most. Auto, cement, these are also the sectors that will benefit around the time of festive season. So there's a keen eye right now on how soon this will come in, Samir. And it's a very short window. How much do you think the market is really awaiting this? And what do you feel will also be the disappointment if we don't see this in time?
So the disappointment will be if they try to be over analytical and have what we say, oh, below 2500 rupee shoes here and above 2500 rupee shoes in a different
Sure.
category or some shirts below X amount. Don't be over precise about these things. It won't matter, and but lead to a sort of a soaring of the excitement that we may have with this. So in this, my feeling is that any tax deduction is good or any GST cut is good because money in the hand of the public is better than money in the hand of governments. And as long as on the net basis there is a big this thing, but also not to draw sharp distinctions between within the same category that below a certain amount is middle class and above that is the super rich. All that is just spoiling the mood if it happens.
Sure.
Hopefully not.
Okay, so GST is clearly one of the reforms that we're watching out for. The Prime Minister has promised a slew of reforms, but this is the first major one that we're anticipating. Let's take a look at the recent performance on the markets as well. The Nifty Small Cap 100 has been down about 6%. The Mid Cap 100 has been down 4%. The Nifty 50 has been down about 1.6%. Nifty Auto has seen some amount of a jump up, 4.5%. Consumption about 3.3%. And the FMCG index about 2.3%. So we are seeing the consumption theme picking out. Is that purely a festive season play, Samir, or is this a larger story? I know you're bullish on the consumption play, and I know you have a very clear strategy around it. So it may not be very broad-based. It may be around particular themes that you see playing out.
So in general, there are 3 big themes in any market. That has been forever, which is financials, consumer, and IT.
Yeah.
And a consumer has been slow for a number of years, but also not only because of maybe lower income growth or lower new jobs or good jobs, because IT sector being a big employer has not increased jobs. Although the losses on one hand may have been compensated by these global capability centers that have been set up, but still not the kind of growth that we had in the past. But the other reasons for the listed large consumer stocks not doing well is because there is competition from unlisted companies, from private companies where each niche somebody's developing healthy food, somebody's developing different kind of cosmetics or shampoos or whatever. And also because of the advent of quick commerce, the one big strength of these consumer companies was that they had big distribution, and now that disruption has that distribution has been disrupted because if you just start a brand, have some money, spend some money, you can try and distribute it through these quick commerce and e-commerce companies. So that's why we don't like the old traditional consumer companies. And also we think that the basket where the consumer spends has changed. So if today monsoon, in the olden days when monsoon would come, everybody would go and buy Hindustan Lever stock. Now the money, if saved via GST or because of higher income, better monsoons, whatever, may be spent on things which you can show on Instagram, and things that you may spend on data, or you may spend on travel or other things which are now the new areas where people want to spend money. Or you might order a few more times at home food, which we will support.
Samir, were you surprised with the kind of numbers that we saw on GDP this time around, 7.8%, that was for Q1 FY26? We also saw, of course, the first major sovereign rating upgrade for India in about 18 years. I mention this because given the somewhat lag in earnings, but overall return scenario has actually been pretty positive. Going forward, can a regular investor in the markets look forward to those double digits or 10% plus returns, or should they be perhaps moderating their expectations given the mix of factors that we're looking at right now, at least for maybe the next 6 months?
10% type return outlook is absolutely reasonable. It should be a little better because big picture nominal growth, although this quarter the nominal growth was very low, but normally you would think that the GDP growth is 7-ish%, and there is 4-5% type 4% type inflation. So you have 11-12%, 10-11% nominal growth. But the way to look at it is that on a relative to what are the other choices, the other choice with which equity is compared is fixed income or debt. The thumb rule is that you make 5-6% more than what you can make in debt, and debt is viewed as 10-year government bond. So this data is widely available for all countries around the world for the number of years that their stock market has been in existence, which in many cases is 100 years and more. The thumb rule is that you will make 5-6%, and this is consistent across markets and across slightly longer periods, because it's not literally every year that you will make 5% more, but on any 5-10 year type period it does end up being that. So in India previously the government bond used to be 9%, and the market used to say and actually deliver on an index level 14-13% type of returns, and it was consistent, and also it was consistent with the GDP growth being 7-7.5, inflation being 5-6%, 13%. So you say the private sector will do better and the listed guys will do better, and therefore the market used to do that. Now inflation is low. Why is it low? Because activity is low, because growth is low, and therefore interest rate is low, and therefore the returns will also be low. But you have to look at the spread, and the spread of 5-6% is reasonable. Therefore 10% plus is very reasonable over long periods, annualized.
Okay, so in the immediate term, I'm asking again, just from the perspective of, the small investor who may be watching all the news play out and wondering what's happening to the stock markets, would we, reassure them to just hang in there because the India story, of course, continues to be strong? That's definitely the consensus. Or would you advise them to perhaps, exit at this stage, wait it out, reinvest? What would be your
It is not practical.
your opinion?
It's not practical also. Even if somebody knew that the market can fall 5-10%, first of all, you don't never know. You will sort of analyze and believe that it will fall 5-10%. But normally it's very difficult to get that right. Just look at it that Mr. Buffett has been sitting on $300 billion cash. And during the time he had this 300 billion, the US market is up more than 60%. This was a recent article which I tweeted also from Wall Street Journal. So you can see that it's very difficult. And then also you have to get two things right. You have to get the selling right, and then you have to be able to buy when it corrects. And then people at that time drag it. So the thumb rule has been that in general, over time, markets give 5-6% more than debt. And since you will not be able to precisely know, because sometimes you may think everything is bad and then something else happens. For example, right now it might be that just US and India agree for their next trade deal, trade talks, which have
Exactly.
been postponed. So this market that fell about 2% in August, you will get 2% in one day, according to me. Whether after that what happens, I don't know. So these things are
Exactly.
very difficult to time and very difficult to implement. And that is why nobody, as in really nobody has gained. Theoretically, it is great to be able to time. Practically, it is easier to stick in. And also, the way this small investor works is that he's earning from his job and he's investing monthly from his
Yeah.
savings. So then, what will he do? 3 months he'll wait, and fourth month he will be told. Nobody will know. It's not worth it in even a slightly longer period.
But you would reassure them that the India story continues to be strong. I'm asking again because,
We
there
can
are
do it
these fears of
differently.
some massive exodus.
So we can do it differently because how can we reassure, but we can say what we are doing. So,
Yes.
I manage a long short fund where you can be long and short, and my net is much higher than my longer term average. We
Okay.
separately in India manage mutual funds where we are allowed to keep cash. It's not that somebody's told us to not keep cash, but we have no cash. We get money every day and we invest more or less every day. We
Okay.
have one fund, which is an offshore account which I manage, which is a long only fund. And it is 99.95% invested. In fact, I've been told that I must sell a little bit to pay expenses of that fund, like 10, 20
Fantastic.
basis points. So it is as full as that because
Okay.
India has done badly relatively, and normally that kind of relative underperformance is a point from which normally this is unsustainable because India over long period has done very well and over one
Yes.
year is one of the worst performing markets, but it doesn't look that it deserves to be that bad. The last news was bad, which was this extra tariff. It is not
Yeah.
super bad, but obviously it was negative
Of
and this
course.
led to more selling than normal. And that is also now sort of, either it'll be accepted or it'll be reversed or reduced. And that will be on the margin as positive as 2 3% as it was negative, and then we can move on with the regular returns and results that we have had in the past.
Okay. So what else are you looking at in India, Samir? I know recently you also picked up DLF. You're also looking at real estate. Am I right? And what's making you bullish on whether it's real estate, whether I know you're looking at energy. What are some of the other themes that you're
So
positive on?
actually, we DLF we have not had recent purchase. I think I don't
Okay.
know, maybe the mutual fund guys. You see, they keep getting new flows, so that confuses it because all the time they have to
Okay.
buy some of their stocks. But as at least me, because I don't get money every day, it's
Sure.
not as this thing as the mutual fund. So the new purchases would not have been there. But generally, as I said, we are running at nearly full
Okay.
weight, and most of the money is in consumer and financials, and the rest would be in energy for sure, and in these food delivery and auto, only two wheelers, and particularly EV manufacturers.
Okay.
So that is where it would be. But energy also, we have not added new money.
Okay.
Uh,
And within financials, because I know that's a large basket for you, of course, are you, again, looking at strategy a different way? Do you continue with the existing names? Are you re-looking at that portfolio? Or what are your
so we
expectations
have,
of
yeah.
returns from
So
that basket?
we own the banks and NBFCs,
Yeah.
but we did a one call again, big call that has gone right is that for the last 4 5 months we have been very negative on market intermediaries because
Okay.
the speculation in that means the exchanges and the brokers, the market speculation has been very high, and it is clear intent of the government to bring it down. And one thumb rule is that you don't fight governments or their policies.
Sure.
Uh, and recently, when they sort of got after the this cricket betting and all that, these gaming companies, you can see that the government has sensed that the cuts that they give, the tax cuts, the GST cuts, and previously the tax cuts
Yeah.
in the last budget, all that money cumulatively or in aggregate gets wasted in punting in stock
Yeah.
market or in cricket. And once you've done it in cricket, which is more like a religion, to go after that in stock market is just easier mentally. So, and also the speculation was a bit too much. So that sector we mostly sold. I shorted it also for many months. But otherwise, in the typical normal rest of financial sector, that is NBFCs and housing finance companies and consumer finance companies
Sure.
and private sector banks and even state bank, we have owned or bought more over time. Yeah.
All right. Before I let you go, Samir, I'm going to pin you down on some stock choices, particularly from the wider basket, because I know everyone's going to be curious. I know you said you don't necessarily look at that every day, but still, your top 3 favorites right now.
Top 3 separate sectors.
Stocks.
No, stocks we don't talk, but it's very
I
easy
know.
for you to see because broadly now we have a mutual fund. And although technically I'm not the mutual fund manager, I'm the offshore fund manager.
I know.
But because the research is common and the thinking process is quite similar, you can get a big idea from what the mutual fund guys are doing.
Sure.
And that comes out monthly.
Yes, I know. That's what we continue to look at and continue to track
So
closely. I'm
please
still
look there
trying to pin you
for all
down.
this and ask Dinshaw Rani next time you see him.
All right.
Why he owns them. But some of them I will also own because broadly they are quite similar. But I may not own 100% of what is over there. Yeah.
Absolutely. No, we continue to track it very closely, Samir, and see, what direction you see the market moving in. What a great conversation this morning. Thank you. And,
Thank you very much.
it's particularly important at a time when we're seeing so many shifts on the geopolitical stage. Thanks so much for joining us this morning.
Thank you. Thanks a lot.
If you like the video, do like, comment, share and subscribe.